Businesses and companies have different types of expenses that they incur as part of running and operating their business. The two most common way that we differentiate those expenses are between operational expenses and capital expenses. So an operational expense is a short-term expense, stuff that we use to run the day-to-day of the business. It's all of that stuff that is generally smaller in value and also is just about the day-to-day running and operating. And when we're thinking about the difference between operational and capital, there's a time component to it. So operational are generally shorter term expenses, whereas a capital expense is a piece of equipment or something that is going to generate value for the organization over a longer period of time. And the way that they're accounted for is different. We may think, well, I'm just spending money on stuff. It should all be accounted for the same way. But how we do accounting in the United States and around the world is we account for those different types of expenses slightly differently. So an operational expense, we just take revenue, the cost of buying the paper, buying the toner, and we subtract that from revenue. That will end up generating what our net income or net profit is. For a capital expense, we reflect the value of that asset on our balance sheet as an asset. And then over time, we'll account for the expense related to that as depreciation. So instead of paying for that capital expense, that printer all at once, we'll smooth out the expenses related to that piece of equipment over time, depending on how long we expect that piece of equipment to be useful. So if that printer costs $10,000 and we expect it to be useful for 5 years, you would expense as depreciation $2,000 every year related to operating that printer. So why does this matter? Why does how it's accounted for in the organization's accounting systems and rules make a difference to anybody? Well, if you're in sales and you're selling a product that's going to be accounted for as an operational expense versus a capital expense, the angle and positioning for how you might want to set up your product and how it will add value to the organization will be pretty different. So if you're selling a product that's an operational expense, it's something that's disposable, it's something that's going to be used up, well, the organization is thinking about what are the short-term impacts of that product. So how is it going to lower my cost in the short term? Is it cheaper? Could it potentially be reusable for a few times? Is it going to drive some short-term level of efficiency? Are there going to be bulk discounts? It's more around the pricing of the product than anything else and how you're going to demonstrate that short-term value. If you're selling something that's a capital expense, well, now we're thinking completely different time horizon. We're thinking long-term. Pricing is not going to be as sticky of an issue. You may need to think about what are the different financing terms that I can bring into this. Given that it is seen as a long-term investment, how can we assist the organization in smoothing out the expense for that over the long period of time? Also recognizing that if you're selling capital expenses, organizations typically have limited buckets of money, of capital, that are dedicated to capital expenses. If you're selling an MRI machine, for example, well, that may be, in the $1 to $5 million range for a single machine, right? Well, that's going to be a capital expense. It's driving long-term value for the organization over time. Now, when the executive team is going to sit down and look at how they're going to spend their capital dollars, they have a set budget for how much that they can spend. And it's not just MRI machines that you're competing with. So if you're Philips, you're not just competing with GE or other MRI companies. The stuff on that list is like the parking garage. It's like the boiler that needs to be replaced. It's a retrofit of the cafeteria. When you're thinking about that, your competition expands to all other capital expenditures. It's not just your product compared to your direct competition. It's your product versus all CapEx for the whole organization for the whole year. So figuring out how to demonstrate the long-term value of what your product is relative to even other competing priorities like infrastructure should be part of your thinking as you're figuring out how to position these products.